Mark, so nice to have you back.
Hi, Dr. Ram. How you doing?
Doing well. And you kept up your promise. I think it was January, something that you did. And later on, you came with the memories of your sensei and Iwata and your other sensei. And then you had told me that you'd come back in the month of August. And here you are, back with me.
I always keep my promises.
You always do, and you're on my... There's a standard work, right? So I got to introduce you. There we go. Now we're going to do lean accounting and accounting for lean. People have been waiting for this, Mark, because one of the things that, throughout my 27 plus years in the Gamba, the CFOs never used to come to the Gamba. And it was so tough for me to tell my client and the CEO there that these are the savings that I have done and lean works. And I could not get the figures of the savings and whether it hit the bottom line or not. And I think many of the continuous improvement professionals who would be listening to this episode of ours, it'll be a good education for them as to how to do lean accounting and how do you account for lean. So just a quick go through standard work, as you always tell me. There you are, President and CEO of Lean Horizon Consultant. Back there is your trademark with two mountains. You told me why two mountains were there. That's Mount Fuji, right? So great. So
yeah, I wanted to have Mount Fuji on my. If you're looking behind me, my symbol, the red is the rising sun because of my respect of my Japanese mentors, and then I wanted to put Mount Fuji in there because it's such a beautiful mountain. Except for when you're on it. When you're on Mount Fuji, it's not that beautiful, but from afar, it's beautiful. Yeah.
I was there with the strong wind hitting me on my face. It was quite terrible when you're up there.
Yeah. But but what happened was when I did the symbol, I had one mountain peak and it didn't look right. So I added another one. Okay. But symbolically, that's Mount Fuji. And again, the whole thing is to pay respect to my mentors, especially Iwata and Nikao, that I got taught and mentored by, who were the originators working for lieutenants for Tashi Ono, as they developed the Toyota production system way back when. So that's what that symbol is all about. So
yeah, you explained to me what the horizon means also, that as you go further, the horizon moves further. So it's a continuous journey, a continuous...
Yeah, it's a continuous journey. So when you look out to a horizon and you pick that point and you journey to that point, what do you see? You see another horizon. And you'll always see a horizon no matter what you do on that journey. There will always be one in front of you. And that means it's a continuous journey that will never, ever end. So that's why I called this Lean Horizons.
Yep. I do have to introduce you, member board of directors with Helen Brand, Danaher Corporation. Everybody knows you. So I don't know why I'm introducing you, but standard work. And Corporation, and there you go. University of Hartford and Central Connecticut State University School of Business. I find it difficult at times to pronounce certain words. Connecticut, how do you pronounce that?
Connecticut.
Okay.
Connecticut is and believe it or not, it's an Indian word. I have no idea what it means, but it's an Indian word.
I'll trace it out. It must be somewhere in the Sanskrit part of it, right? So this is what we're going to talk about. And you are there in Shingo Pirates Academy in the Hall of Fame. And this is what all of us have been waiting for. To hear from the person who was first to introduce lean accounting process in US for Danaher brake division. There we go, from from the author himself of Flatline, and this is what you were the first person on my episode. You started me off, and you were responsible, thankfully, for making me Dr. M. Thank you very much for that, my dear mentor. Flatline, I'm continuing with the series, trying to find out from various parts of the globe as to how they are coping up with this. Various models have come up ever since we started our episode 1, and now it is episode 28. So we're going to talk about lean accounting and accounting for lean, and I hand it over to you, Mark. And you're there always on the Dr. M's vodcast. Support and sustain continuous improvement processes. I'm going to stop sharing and I'm handing over to you, sir.
Yeah, not only did I name you Dr. M, I created a monster.
Monster. You know what? When you're going to explain this lean accounting to me, please know that I'm a Gemba guy, so I would not know much of the financial terms. So you have to explain to me too.
Oh, come on. This is going to be easy. This is going to be easy. Well, okay, let's start. So, you know, Dr. M, I started my career in accounting, cost accounting. And I worked for companies like Lego, the toy company, and a blasting products company for the mining industry. I worked for a typewriter company, which is now, of course, out of business because we don't do typewriters anymore. That's how old I am. And I also worked, and then I went to work for a company called Jake Brake in Bloomfield, Connecticut. And little did I know, Jake Brake was the birthplace of the modern lean movement, where we were the first ones to bring over a company called Shingajitsu. And in particular, my mentors, Mr. Chihiro Nakao, and Yoshiki Iwata. And those two guys started that company, Iwata being the founder, and along with Nakao. Unfortunately, Iwata died. I talked about that on your other vodcast,
yes.
About my relationship with Nakao and Iwata, so I won't go through that again, but they were so special to me. And we started learning this thing called the Toyota Production System. You know, back then it wasn't even called Lean. In 1987, or just maybe starting to be called that, in the book Machine That Changed the World by Jim Womack and Dan Jones. So anyway, I started there in manufacturing accounting and cost accounting. And as I learned more and more about Lean, or the Toyota Production System, the more I realized that all the things that I learned in traditional cost accounting, and by the way, I was a very good cost accountant, and I learned from some of the best. And matter of fact, one of my biggest mentors, Dr. M, in cost accounting was a guy from India, and his name was Chris Mather at Lego. He was unbelievable, and he ended up passing away from a stroke. He had diabetes, and he passed away at an early age in his mid-40s. And that's when I took over his job at Lego, and he was phenomenal. So I was very well schooled in cost accounting. But now that as I started learning more about the Toyota Production System, and eventually what we call Lean, and then the Jacobs Production System, which, as you probably know, evolved into the Danaher Business System, which we transformed into the Danaher Production System, which we transformed into the Danaher Business System, which I led that charge for almost a decade, working for George Sherman, our CEO. I learned that the things that we were doing in traditional cost accounting were promoting so many unlean behaviors. And what I'm going to talk about today is just that. So, you know, it was hard to undo all the training I had, whether it was from my college education to my certified management accounting certificate. You know, I'm a CMA, and also from the work I've done with these unbelievable leaders in cost accounting. Okay, I had to undo my thinking on all of that. And it was probably one of the biggest professional changes I ever had to make. But nothing made sense to me once I really understood the essence of the Toyota production system. Okay. So that's what we're going to talk about today. So the agenda is, is we're going to talk about a couple of things. Introduction, of course, which I already started, a case study on lean accounting, a case study for accounting for lean, and I'll explain the difference. And the conversion process, how do you go from traditional to a lean accounting process? And then, kind of a wrap up. So that's kind of the agenda
Yeah,
that
that's
we're going
good.
to look
That's
at.
good because the case studies will give us the feel of how it is done. So I would love to
Yeah,
hear that.
yeah, exactly. I wanted to show you a real case study of what
Yeah.
we did at Break. Some of it might be a little dated because some of the technology back then is different, wasn't as advanced as it was today. Okay, but I'll get into that. But the concepts are still there. Okay,
It's back to
so
basics.
yeah, the basics are still there.
Yeah.
So that's what we're going to do. So, let's just start first with some definitions, right? What is lean accounting? Basically, lean accounting is applying lean methodologies to take waste out of the accounting process itself. So, no different than how you would take waste out of any process, right? Whether it be a warranty process, an order entry process, a manufacturing process, you're taking waste out, which is what we call muda, are the 7 traditional waste from the Toyota production system. And we talked about those waste in another podcast that you and I did on the Toyota production system itself. So I think a lot of people know what muda is, but you can always look that up and go back to that other podcast to see what that's all about. But taking waste out of the accounting process. So for example, errors in accounts payable, productivity, how many invoices do we do? Closing the books from 20 days down to 2 days. How do we take all the waste out to be able to drive value? And it's an important part of what we need to do in the next step, which is accounting for lean. And why is it important? It's important because I wanted my accounting team, when I was as chief financial officer, I wanted my accounting team to be navigators, not historians. Okay. And when we're so busy taking 20 days to put the financial reports together, and we're, correcting errors and, reforecast, doing all that stuff, reforecasting and all that, we had no time to be a value added partner with leadership because we were so busy, swatting flies and putting out fires on things that were wrong in our accounting system. And a lot of that had to do with all the waste. But that's important because accounting for lean is actually modifying the accounting process itself so that you're driving positive lean behaviors. And I'll explain that as I get into this. So that's an important part, but you really can't do accounting for lean if you don't have your waste out of your accounting process itself. So on accounting for lean, a lot of the waste that we look at are what we call Mura and Muri. So you've got unevenness, which is Mura, and then you have Muri, which is what I call unreasonableness, if you will. Those are usually driven by policy, okay, and we wanted to be able to get that kind of waste out as well, and not drive bad behaviors because of the measures that we were producing out of our accounting system. Okay, and I'll get into that again in a minute. So what I'm going to do is, actually go through, what is lean accounting, what is accounting for lean. Then I'll show you some case studies. So, we're trying to eliminate waste from the accounting process. And why do we want to do that? Obviously, more timely information, better quality of information, frees up our resources so that we can be value added. Again, I talked about being a navigator rather than a historian, and really understanding what our customers wanted out of the accounting process itself. more than just paying them with a paycheck every week or whatever it was. How could we really add value to leadership so that the information we provided is reliable, it's believable, it's meaningful, it's timely. Okay, it's not coming 3 weeks later or a month later. Good luck with that. I remember Nicole telling me, we were on the floor one time, and just to give you an idea of why timeliness is so important, he said we had one of our quality guys came up to Nicole one day with a report, and Nicole and I were standing on the shop floor, and he said, "Nicole-san, here's our quality data from last week," and he took it and he ripped it up and threw it on the floor and stomped on it. He goes, "No good," and the quality guy didn't know what to say, right? And Nicole says, "Why did you do that to my report?" He said, "What did you have for lunch today?" And the quality guy says, "Well, today I had a hot dog," whatever it was, right? "What did you have for lunch yesterday?" "I had pizza." "Okay. What did you have for lunch a week ago?" And he couldn't remember. So Nicole says, "You can't even tell me what you had for lunch a week ago, and you're going to figure out what happened a week ago with this quality report? This is muda. No good. No good. You address your quality now when it happens. You don't put it in a report and then look backwards. How are you going to recreate the conditions to be able to understand and problem solve that quality error? This report is garbage," he said, as he's stomping on it, right? And he made a point. Well, it's the same thing with accounting data, okay? Accounting data is, excuse me, accounting data is the same thing, okay? It's historical. You can't do much with it because it's, in the past, and you can't take those countermeasures, So we had a notion that said, if you want to make the year, you've got to make the quarter. If you want to make the quarter, you got to make the month. If you want to make the month, you got to make the week. If you want to make the week, you got to make the day. And if you want to make the day, you got to make the hour. Okay. So the whole notion of that concept is that we want information to be as timely as possible. So I would tell my guys in accounting, I want to be able to close the books every second of the day, which is, we never achieved that. But the philosophy was, I don't want this to be a batch process. I don't want this to be something that we have to wait 2 days. Even if we close the books in 2 days after the month, it's still old, okay? So we have to have information that is current today that I can act on, okay? And not wait even closing the books in 2 days is phenomenal. That's great. But it's still historical. It's still looking back for the last 30 days. And you sometimes can't do anything with that info. So we had to put in things during the month that would be quick triggers that we'd see what's going on real time, so that we can actually do plan, do, check, act, going back to Deming, right? And the Deming cycle. So even with a 2-day close, you still fundamentally had a lag, right? And I used to talk about a monthly close, and we did them 12 times a year, okay? All that was a quality check. We were inspecting 12 times a year. That's what a closing is, okay? And we close the books, and we do it 12 times a year. And so I want to get to a point where, theoretically, we were closing every second, so I didn't have to batch 30 days into a close, right? And then if I had issues along the line in a type of flow of information, I was able to react immediately, okay? So that was the concept, right? So even though we closed the books 12 times a year, and we did it in 2 days, we still had interim signals that would let us know critical things that we needed to know, so that we didn't have to wait to find out that we messed up a month ago, So that's this is taking the waste out of the accounting process. And I'm going to give you a case study on this. Accounting for lien is different. It really talks about driving, dysfunctional behaviors that promote building of unnecessary inventory, which is a violation of just-in-time principles. And again, you and I talked about just-in-time as part of our vodcast on the Toyota production system. You and I broke down the house
Yes, that's
of
right.
TPS, of House of Ono, I call it, and went through every single step in that. And one of those pillars was just in time.
Yeah.
So building unnecessary inventory basically means that you're violating just in time principles. Um, long production runs, okay, so that, you know, promoting long runs so that you're not shutting down to do changeovers. Well, there's a totally counterintuitive notion that we've learned from our friends in Japan, and that was you want to do more changeovers. Why do you want to do more changeovers? Because the closer you can match your production schedule to your demand schedule, the less inventory you need, and the quicker your lead times. Okay, so faster your lead times. So I used a real life example of a barbecue where, you know, I've asked people to understand this. When you have, or you're making hot dogs and hamburgers for 20 of your friends and family and relatives, you don't just make the hamburgers first. You make hot dogs and hamburgers at the same time. Well, why? Because the demand is for both. All right. You don't want the people who are eating hot dogs to wait while the hamburgers are being cooked. You want everybody to eat together. Well, production is the same way. When you're ordering different models of parts or whatever, you know, they're not ordering, you know, part A only and waiting 3 weeks for part B because you don't want to do a changeover. So the more changes you can do, so that means that some of these variances that we calculated in a traditional sense really discouraged more changeovers. All right, and the EOQ, or economic order quantity methodology, we had to kill and get rid of that. Variances, I'll talk about variances from standard cost, which we got rid of altogether. Capital decisions, I'll talk about that. How do we look at capital differently than a traditional financial person would look at it? All right. Then, of course, you've got the more accurate financial information. One of the big issues with cost accounting is how you treat overhead. And overhead, you know, normally gets spread out like peanut butter on a piece of bread, where everybody kind of gets it based on some arbitrary allocation based, like direct labor hours, machine hours, whatever it is. And those allocations are absolutely useless, and they're absolutely uh, nonsensical and not meaningful. So what we tried to do is focus on driving our overhead cost to a value stream, and I'll get into that in a minute. And then greater accountability. Okay, the cost data was not now arbitrary, like I said, with some crazy overhead percentage. Um, and now we're able to really make some good decisions based on really reliable and accurate and meaningful data. Okay, so that's what accounting for lean is all about in terms of what we're trying to do with it.
We would cover that up in the case study, right?
Yes, sir. These are coming up. Okay. George Konensaker, who was our leader, our president, and he worked for Art Byrne and I worked for George. He said that of all the areas of Jake Break, Mark's finance team achieved the largest productivity gain in all of Jake Break. Okay.
Kelly, who did they? George passed.
George Konensaker was the
Passed, yeah,
president.
yeah, passed. I mean, recently, a couple of months ago, he passed on, right?
No, you're talking about George Sherman.
I mean,
George Sherman was the CEO of Danaher. He's the one that passed on.
I'm
Yeah.
sorry. Yeah.
Yeah. George Konensaker was a real catalyst. He and Bob Pentland and Art Byrne, who brought in Shingijutsu, and I happened to be working for George. And he hired me at Jake Break, and he's an icon. Matter of fact, he's a guy that you got to get on your show. George is phenomenal, along with Art Byrne, by the way, and Bob Pentland for that matter. All three of those guys were big mentors to me, and really were. And so George, you know, made this statement that I had the biggest productivity gain in all of Jake Break, and we'll get into that in a minute. So let's talk about, this is a case study. A case study for accounting, for lean accounting. Okay, this is what the business looked like at the time when I became CFO. Okay, you can see we're barely making money. We're going to be going out of business soon. Uh, we had lousy inventory turns and on-time delivery and long lead times and, and all this, right? Well, this is what my accounting department looked like back in 1988. So you could see the headcount distribution here, 25 people in this whole thing, right? And that's what it looked like, right? Now, I want to make a point here that these people, when we reduced the headcount, I believe we went down to 9, and provided more value with 9. The other people were redeployed to other parts of the business. Like one of them became a buyer planner. The other person went to work for engineering in their CAD system, that kind of thing. Anyway, so
No, that's a
only
good no, Mark. I think that's a good point that you brought out, because people should not be left with an concept that we reduced the manpower, we threw them out of the job. No, that's not what you said. You said that
no,
you redeployed them, right?
exactly. And by the way, these people were part and parcel to making these changes, okay, and making the improvements. So they were on the Kaizen teams, okay. So no, you can't do that. We had a no layoff policy, Dr. Reb, no layoff policy with the union and with us, that we were not going to lay people off as a result of making improvements with lean. What we wanted to do is grow the business. And now I will refuse to work for a company who will fire somebody when we come in and work with them to improve their business through lean. As a matter of fact, there's some big companies, and one's a very big one that's notable. I won't say who it is, who they wanted me to come in. And the first thing I asked them was, will you guarantee a no layoff policy as a result of lean improvements? And the answer was no. So I refused to work with them. Okay. And, I could easily have gone to work for them and made a lot of money and all that. But, I got to look at myself in the mirror, and that's not what I do. I'm not here to put people out of work. I'm here to, to grow businesses and keep businesses here and not go to China with the businesses and all that. And so, long story short is we had a no layoff policy. I will tell you, one of those people, though, on the 25, I had to let go because of values. Okay. And it was a performance issue in that regard, but it had nothing to do with making improvements. Okay. So anyway, that's the situation that we had. Okay. Now this is just one example of accounts payable. Okay. And this is what now go back to accounts payable here. We had 3 people in accounts payable and we had 1 person in receivables. Okay. And they'll come into play in a minute. So this is just a very basic view of how we, at that time in the late 80s, paid an invoice. Okay. So what we did was the mail got delivered. Everything was in mail. Okay. I remember nothing electronic, no barcodes, none of that stuff. Mail got sorted. It got sorted by the alphabet. So of the 3 ladies that we had that did accounts payable, one lady did A through K, another one did L through P, and whatever, how they split it up. So when the mail came in, any vendor that had, let's say, Alpha went into the first pile, and Acme went into that pile, and a Micron machine invoice went into the M pile, and they all split it up into the 3 piles of what they're responsible for by the alphabet. And you look at that and you ask yourself, well, where's the value add in getting that bill paid by sorting the mail? The answer was there's no value added there. So again, applying our view of waste on these kind of processes was what we looked at. Then we had to open the mail. We had to calculate batch controls, because that's what our computer system demanded, that we put them in batches. So if I had 10 invoices, I had to add up all the numbers on that we were going to pay, and make sure that when I entered all those 10 invoices, it added up to that batch total. Okay. That was a control. That was a big waste there. It did nothing to promote paying the bill. Then we had to enter the invoices, and then we had a bunch of exceptions. Oh, this one kicked out. This one doesn't have a purchase order. This invoice is it got the wrong, it came in gallons and we really ordered it in pounds, right? Unit of measure issues, all kinds of issues. So we spent most of our time, Dr. M, correcting errors. Of all of this that's going on here, then we have this filing system was ridiculous. So of all the things that we did, the biggest problem was right here. Okay. And believe it or not, it was a quality problem. Now thinking about accounts payable from a quality perspective was brand new to us. We never thought about it that way. Matter of fact, we kind of just accepted that this step right here of correcting invoices or problems with POs or whatever was our job. Okay, that's just what we did. So we standardized. We almost became good at correcting things. Okay, but we never fixed the root cause of the problem. It was actually institutionalized in our business that this is just what we do, right? And nobody really looked at it from a quality perspective. That was an error. And then, of course, uh, you know, the productivity that came out of this, because you'll see in a minute that we not only did accounts payable with one person, but we did receivables also with the same person. Okay, the productivity is a result, as our friend Deming says on the right, of doing the right thing with quality. You cannot lose weight by just looking at the scale. You got to look at the drivers of why you weigh what you weigh. So when you look at your weight, and let's say you're 200 pounds and you want to get down to 170, well, I can look at that scale all day, but if I don't start counting and understanding calories and exercise and all the other things that go into losing weight, then the scale is not going to move. So I can't just focus on productivity and say, hey, go work harder, right? No, I've got to focus on the process and not the people, right? Yeah, you got to train the people and all that, and they got to be part of the solution. But Deming also said at one time that 96% or 94, whatever the number was, of a company's problems are process problems. And that's exactly what we found here. Okay. We had good people. They were all good people. And it was not like the people were the problem. They weren't.
He called them the willing workers, right?
They're what?
Deming called them the willing workers.
Yeah. There's nothing wrong with them. And by the way, when he's talking about respect for people, you see the woman in the middle there. It's disrespectful to have people come to work every day when everything is broken and no line of sight to get things fixed. Okay. So this is where lean comes in with standard work, as I'm going to talk about in a minute, and all that. So this is an important thing to think about here, that your people, you're being disrespectful when you're working in chaos and offer them no avenue to make a change. Okay, that's a little bit of a deviation from what I'm talking about, but it's very important to understand that. So anyway, this is kind of like how we looked at this thing. Now we did a more detailed value stream map and all that stuff, but I'm not showing that here. But I want to give you a little bit of an idea of what we're trying to do. So we focused right in on that quality as the major issue. And here's our Pareto analysis. And thank you, Dr. Duran, for coming up with Pareto. Matter of fact, Pareto's birthday is coming up soon. And Colleen and I are going to be writing a poem to commemorate Pareto and Duran, who created the Pareto chart, as you see here. So this Pareto chart is, we looked at this and where were our errors? So we collected the data. And by the way, when you collect this data, you don't have to collect it for 5 years. Collect it over a reasonable time period that gives you a feel for where your issues are. Make sure it's representative. And so the biggest problem we had was we had missing purchase orders on our invoices that we couldn't pay because the PO was missing. Unit of measure issues, wrong quantity, no receiver, and other issues as well. So these were the biggest issues that we had. Okay. And so again, 75% of our time was spent on just dealing with these errors. All right. So we ran specific Kaizen events around each one of these errors. So we had a Kaizen or so, or whatever it was, on missing purchase orders. then we had one on unit of measures. And in order for us to do this, we had to elicit people from outside of the accounting department, right? We had to get the purchasing guys involved. We had to get the guys that did the receiving. We had to get the suppliers involved in some cases, because there's other Paretos that we looked here, like, okay, let's break that missing PO down into, hey, let's look at it by supplier. Maybe it's only a couple suppliers that's the issue. Or let's look at it by commodity or part number, or whatever you want to look. You break it down further to understand and direct you into where exactly you have to go. Is the unit of a measure issue, was that simply just 3 vendors that we bought steel from, for example, and they're invoicing us in pounds and we're receiving it in feet or whatever, so let's narrow this down and break this down into further Paretos so that we can really understand what each one of these bars is telling us. Okay. So that's how we looked at this. This is a very basic quality tool. It happened to be Dr. Joseph Duran's favorite tool. When I asked him, what is your favorite quality tool? And he laughed and said, well, it would have to be the Pareto diagram, since I'm the one that invented it. I go, okay, I'm cool with that. He also said his least favorite was QFD, quality function deployment. Interesting. He said it was too complicated. So anyway, here we are. That's our analysis, right? So what do we do? Okay. We developed standard work, and I'll show you that in a minute, for accounts payable. And by the way, did we do a session on standard work? I think we did, Dr. M, didn't we?
Yeah, we did.
Okay, so that's another podcast that people should be looking at on your YouTube channel, of standard work and what that's all about, right? So I'm not going to get too involved in that today, but I think yeah, we did do that YouTube video, that vodcast. That should, another thing you guys should go look at is go look at our video on standard work. We designed a cell. Okay, an accounts payable cell, where we created one piece flow, not batchy, not sorting things by alphabet. Okay. And by the way, whenever you do an administrative Kaizen like this, you've got to have your IT people right by your side, because many times there are system changes, and the last thing I ever wanted to hear was the system won't let us do it. Well, do we work for the system, or does the system work for us? That was never an acceptable. My people knew not to tell me that. Well, the system won't let us. Yeah, well, throw the system out then. Okay, I'm not accepting that as an answer. Sorry. Okay, so do not let your people tell you the system won't let us. Who works for who? Okay. One piece flow, as I indicated, with the invoices. Okay. A hospital bed, so that we can isolate and quarantine our quality defects, so we can further analyze, and of course root cause quality tracking improvements. So this was the KPI.
Can you digress on this, because that's a unique word that you use, hospital bed?
Yeah. Well, what we didn't want to do, and I tell people this all the time, is if you think about your accounts payable people as operators making a part, the last thing you want to do is perform rework. I'm not saying an occasional issue, okay, but when there's chronic rework in your flow, to have your operators spend time troubleshooting, especially when you get electronic parts, right? When you've got stack up tolerances and you got all kinds of issues, and people are swapping out components to see if it's going to pass the test and all that, then you've just turned your operations into a I don't know, a skunk works type of thing, because that's not what operators should do. Okay. And I'm not saying that you shouldn't fix a quality problem when you see it, but if it's a chronic thing where most of the day you're chasing your tail with quality issues that are chronic, that is not the job of an operator. And so we had chronic problems here, and I wanted to isolate all of these non-payable invoices because of all these various problems, and not have my people leave their desk and go find out who owned the PO and come back and get the PO. No, we had to isolate these things, Pareto, and then go after them Kaizen by Kaizen by Kaizen. Okay. And that's something I tell people all the time is do not turn your production process into a rework process. That's not what they're supposed to do. Anyway, and I found this cartoon, I thought it was kind of cute, where it says, may sound kooky, but if we increase quality, I mean, quality is so much of a driver of everything. It's a driver of lead times, on-time delivery, customer satisfaction, productivity, which is a result of having good quality, right? And how you characterize what quality is, many times people want to characterize quality as a technical deviation from an engineering drawing. But quality could be captured in so many different ways. For example, if your machines break down, that's a defect. Okay. If you get bad specs from a customer in terms of a customer order, that's a quality defect. Okay. When we got bad invoices in with no POs or bad unit of measures, those were viewed as quality defects. And a lot of companies, although it may sound very simple today, they still don't view them as defects. And so I tell CEOs all the time, I want you guys to get your team together and let's have a conversation of what we view as a defect. And inevitably, it always starts out as, well, when the engineering spec the product does not meet the engineering spec, and you get these engineers and quality guys just talking in that regard, not thinking about the fact that it took us, 10 days to get the right data to build the right part because the sales guy didn't collect the right data from the customer. Okay, they don't think about defects in that regard. Engineering change notices, thinking about each one of those is a defect, right? And why do we have to have an engineering change note? Well, because something changed and it was wrong to begin with. So somebody passed on bad data or whatever, and that means now we have to reorder the different parts. We have to go back and rework a part that we built with the wrong components, whatever it was, right? Those are defects. So having that conversation about how you view defects and what your definition of a defect is, to me, is very important. And my very simple mentality on this is a defect is anything in a process that needs to either go through that process again. In other words, it did not flow through that process correctly the first time. And I don't care if it's an airline ticket, I don't care if it's a product, it doesn't matter to me. If it didn't flow, it's a defect, okay, based on your process, right? So anyway, that's how we looked at this here. A little bit of different mentality that we had to instill way back then. Maybe today won't be that breakthrough, but back then it was, because we didn't think about this. We normalized these errors. We thought they were okay. So here's a sample of the standard work that we did. And this is called the standard work combination sheet. And you could see that, first of all, our friend Tayashi Ono says, without standards, there's going to be no improvement. Like, what is it that you're changing if you don't have a standard? Okay. Am I changing what's in your mind, Dr. M, and what it's in somebody else's mind? Well, good luck with that, because you guys think about that process two different ways. And now what am I changing? I have nothing to change. So this particular chart here shows you the manual and the automatic, in this case, the machine happens to be the computer, and the walk time with producing one invoice. All right. Now, if you look up on the top, it says quota per shift is 150 per shift. So each day we on average we had 150 invoices to process, and the tech time happened to be then 180 seconds. Okay. Now that red line is the tech time, and that's one of the things that were driven into us by Nikao in the water. That tech time always needs to be written with a red line. One person said to me, one client says, "Well, Mark, you do that out of respect," because Ono thought that tech time was such an important number. And again, I'm not going to explain all this today, but you go back to our standard work video and you'll see what tech time is. But if you look at this and you add up all the time it takes to process one invoice, you could see that it takes 120 seconds. So that's that bar under 120. But I need to only produce one invoice every 180 seconds. It's my takt time. Okay. Well, how come now I can't do this with 2/3 of a person? If I only need if I need to get one out every 180, but it only takes 120 to do one, okay, why do I need 3 people? I should use less than one person here. It's because of the quality errors. Okay. Because I can't do one every 120. Why? Because I've got all these issues that I described earlier. Right. So this is the standard of what one best way looks like when it goes right. However, it doesn't always go right, which is why we ended up with 3 people. Okay. And all that had to do with quality, and that quality drove our productivity. That's what Demi said earlier. And so here it is. This is what it should be. That's the line in the sand that we drew at standard work, albeit we did not have any probability of achieving this because of the errors, and that's why we had to focus on the errors. Now again, a lot of people say, well, I'm going to put standard work in until we get all the errors fixed. Well, this is the vehicle that you use to measure yourself against, so that you can in fact make those improvements. It's kind of like saying, doctor, I'm not going to take my medicine until I get better. Well, this is the medicine. All right. And to delay because you have all these issues. Well, what makes you think you're going to fix these issues with or without standard work? You haven't done it till today, till now. So what makes you think exactly you're going to do that's going to be different tomorrow when you come in, right? So nothing. Otherwise, you would have done it. This is the one that really highlights the issue, and you start looking at the data like we did back here with the Pareto type analysis. And there were more Paretos than just this. This is where you start using these tools to make improvements. And Tashi was 100% right. Without standards, what are you changing?
Can I stop you there? Because it is so significant that you talk about the standard work and the need for it, because that becomes your reference point, right? Without a reference point, where are you? You don't know how far you are, how close are you, or where are you? You just don't know if it is not for the reference point as a standard work.
Yeah, and standard work is not designed to record and document your muda. Okay, now for example, I've had some people look at this and say, well, Mark, you should have built in how much time on average it takes to fix your quality problems. No, that's not what this is for. Okay. And what this is for is the one best way we know today, albeit there's waste in this too. In this 120 seconds, first of all, I got 10 seconds of walking time. We know that's waste right off the bat, which is why we highlight it. We know that there's a lot of things in those other numbers, those manual numbers, that have waste in them. But right now, this is the one best way. We're not saying it's the perfect way. We're saying it's the one best way we know today to do to pay an invoice. Okay. And so people want to build in time in here to actually show the rework in the quality issues, and that is not what we do with this. Okay, we do not do that.
Always keep improving the standards, right?
Yeah. And so once I can get down to working at 120 consistently, because I took away all the issues, the quality issues, now I'll come back and say, okay, well, which bar would I probably look at here to try to improve on? Well, most likely it would be step 3, which is 50 seconds. Okay. And say to myself, well, maybe what is it about that is taking so long? And maybe I can get that down to 20, or sometimes you can eliminate a step, right? In a lot of different ways. So, but I don't want to mess with that right now until I figure out how can I get to this standard. Okay. And once I get there, I can start attacking everything else, right? So that's kind of how we thought about this, right? So this is a standard work combination sheet. It's one of 5 documents on in standard work. But I just want to bring that in and show you how, from an administrative perspective, how we use the tools, Dr. M, to improve the process.
Yeah.
Okay. So here's the results. Okay. This was after a few months. It was still not perfect. We still had quality issues, but a lot better than 650,000 parts per million. We had a 90% reduction, 92% reduction, and you can see our productivity. You could see our headcount. Okay. And, so these were some of the results that we ended up with on this thing. Okay. And overall, with all the different Kaizens we did and what have you, this is what we ended up with. I said 9 before, 10. We ended up with 10 people in a year. And my notion was that everything that the accounting department did, from producing financial statements to doing payroll and accounts payable and collecting the cash and all that, bank recs, I wanted to do in 75% of the time. That was my goal. Okay. If it took us 100 minutes to do something, I'm going to do it in 25 minutes. Okay. And that was what we were trying to achieve with this this whole thing, right? So this ended up being the head count. There's a lot of other stories I could tell you about what I won't today in this, but you can see where we were at. And again, those 15 people, all but one, got redeployed into other areas of the business. So okay, accounting for lean is now a different thing. And again, this is our friend Ono again saying, hey, costs do not exist to be calculated, they exist to be reduced, right? And so the whole notion of, and everybody's like, oh, well, cost reduction is kind of disrespectful because everybody associates it with laying people off, right? Bottom line is, one of the major reasons why Ono wanted to do Toyota Production System was to reduce cost. And he wasn't shy about it. And we shouldn't be shy about it. It's a good thing to reduce cost and make ourselves more profitable, because that provides growth, it provides job security, and all that good stuff. Okay, so it is a really good thing to reduce your cost. Some people look at it as a politically incorrect thing to think about, right? And no, it's a good thing. Making money is a good thing for everybody involved. And I'm sick and tired of hearing how, corporations are greedy. Corporations are the ones that are providing employment, right? And maybe there's nothing wrong with being greedy, because if we weren't greedy, we wouldn't drive for profitability, which has so many good, not only personal but societal effects of making money, whether it's increasing your 401k and your stock price that you own in your 401k, in your pensions, the fact that you're providing people with employment and you're in job security and increase in wages and all that. Making money is a good thing. We should not be ashamed of that. At least that's my view. So, traditional batch accounting, this is what we were doing. MRP-driven work orders, absorption costing, okay, which is how we allocate fixed costs, right? So the notion of absorption, if you think about this, is if I have fixed cost in my business of $1 million and I produce 1 unit, my per unit cost is $1 million. If I have $1 million of fixed costs and I produce 1 million units, my fixed cost per unit is $1. Did I reduce my cost? No. It's still 1 million, okay? I'm just spreading it out over different units. It's still 1 million, okay? So you could see how badly that measure will drive you to do the wrong things. We applied overhead on direct labor hours. We had this thing called variance analysis, had all kinds of different cost accounting traditional variances. Inventory records, totally inaccurate and meaningless. We chased our tails all the time on inventory. Exhaustive labor reporting system, high volume of inventory and labor transactions, adds zero value to the business. When you're sitting there typing in transactions into a computer system. 0, 0, 0 value. And our product costing was totally out to lunch. All right. That's the scenario. So here are the things that we did. First, we developed value stream costing. So as our company organized into value streams, and in this case, Jake Brake organized around customers. So they had a Caterpillar value stream, a Detroit Diesel, Mack Truck, Hino Motors. I ran the whole Asian business when I went into manufacturing. So I produced for Hino and Mitsubishi. We had and within these value streams, we had cells that made the different various models. Okay. And at that time, we weren't doing a very good job with mixed model production, but we had dedicated equipment for each model of Jake Brakes. And so we looked at this from a value stream perspective. And I won't go through what a value stream is at this point, but we got rid of these arbitrary overhead allocations. So for example, if I had 20 engineers making $100,000 a piece, okay, so what did I say, 20? I got $2 million worth of engineering salaries. And then I said, okay, well, depending on your direct labor hours, you're going to get charged proportionately a part of that $2 million of overhead. Well, we said, no, we're not going to do that. What we're going to do is say, if engineer 1, 2, and 3 works for this particular value stream, they will get charged to that value stream. So what we did is we actually opened up overhead accounts based on a value stream. Okay.
It was not a blanket. It was not a blanket share across the value stream. So it was dedicated allocation of cost.
Yeah. It was dedicated because if I know that Larry, Bob, and Mary, who are my engineers for this value stream, work there, well, their salaries got charged into that product cost at that value stream. So no longer do you have these arbitrary overhead allocations. Okay. And we did that with all overhead costs. And so there were certain costs, Dr. M, that we either couldn't do that with or it was costly to do so. Like, for example, the insurance on the building or the electricity. We had one electric meter. Okay. So we use what we call ABC costing, activity-based costing, for those one-off type costs. I don't like ABC because it's too transaction oriented, and I like to use it only as an alternative. But for example, and again, I had to think about how would we drive the right behaviors. So if you look at building insurance, security for the building, depreciation, all this, okay. I said, okay, well, we're going to basically allocate these building costs based on how much square footage you're using. So if this value stream used, 1,000 square feet, they got their share of that based on the proportion of the total square footage. Now, if they came back and said, hey, I reduced it to 800 square feet, okay, your charges went down. Okay. So there was an incentive for the people running these value streams to really stay tight, reduce floor space, and ultimately we freed up 50% of the floor space at Jake Brake. 50%. And we actually had a basketball court and a volleyball court and the shop floor. Okay. Now, when we grew the business from 65 million to $250 million, we had to reclaim that space. But guess what? We didn't have to move. We didn't have to buy a new building. Okay. So see, the incentives in this system were what we were shooting for here. So when I said, okay, well, how are we going to think about, we're going to give them an incentive to reduce their floor space. It's exactly what we did. All right. We backflushed inventory wall to wall. Okay. I am certified as a CPIM or Apex certification, and I set up the whole backflushing system on the inventory with all of our Kanbans, which basically means that, we did 2 inventory transactions. 1, when we received the raw material, and 2, when it got shipped to the customer. That was it. Everything backflushed. So in other words, if you don't know what backflushing is, some people may not, if I'm making a car and I know the bill of material says, hey, it has 4 tires. Well, when I ship that car, 4 tires are decremented from my inventory, just based on the bill of material. I had to use 4 tires, right? So, so that's what backflushing means, and there's a little bit more to it than that, but that's kind of how we looked at it. And so anyway, that's the first thing we did is drive overhead costs as much to these value streams as possible. Okay, and by the way, we probably reduced the allocations by 80%, I believe. Okay, and so we're all direct costed here, almost entirely.
Mark, I need to hold you there because many of the viewers, you need to reinforce the concept of black flush inventory. I know many of them would know it, but for the general, uh, can you recast this black flush inventory
Yeah.
concept?
Well, again, let's just use the car as an example, right?
Mhm.
So if you're making an automobile,
Mhm.
you know that an automobile on your bill of materials takes one steering wheel. You know it takes 4 tires. You know it takes one front bumper and one back bumper and whatever, right? So I'm going to receive those items into inventory when they come in. So four tires goes into inventory, one bumper and whatever, steering wheel. When I ship it,
Mm.
it takes it out of inventory and charges it off the cost of sales. Okay. So it's that simple. All right. Now you say, well, geez, Mark, you don't have any good inventory records because how do you know what you got? Well, you know how I know how we got? I went out and looked at it. We set our inventory up where all you do is go look at it. To rely on a report, which most likely will be inaccurate, it won't be timely and all that. If you want to know what you got, go out and look at it. Okay.
Mm.
This is where 5S comes in place because you have to visually set your inventory up where it's not all over the place and in this corner and it's disarranged and it's chaos. You have to have a place for everything and everything in its place. So if I want to know how many tires I would have, I go out and just look at it, count them. Okay. And just look at it and say, okay, that rack's got 50, that was 25. I got 125 tires. Okay. That's it. You want to know how much inventory you got? Go look at it. All right. So that's what backflushing is. All it is a simple way to decrement your inventory based on the bill of material. That's all it is. Yeah. I don't know if that helps, but that's as simple as that. Now, eliminated standard cost. And the standard cost is a fixed number that you calculate usually annually for a product. Okay, so if I'm making a computer mice, I'm holding my mouse up here. If you can see my mouse, okay. I'll look at this thing and I'll say, as a cost accountant, well, okay, how much does it cost for the plastic that goes on this and the components that are inside, and how much labor is involved in this? And I get engineering studies and I look at, okay, well, how much overhead am I going to apply to this? And I come up with this standard cost. So let's say the standard cost for this product is $5. Okay. I don't know what it would be, but let's just say it's $5. All right. Now, of all those different things I talked about, whether it's overhead, fixed, variable, labor, materials, and all that, if it's $5.50 actual cost, I have a 50-cent variance, unfavorable. If it's $4.50, I've got a 50-cent favorable variance. But these variances cause you to do the wrong things.
Mm.
Okay. So if you look at these variances, first of all, absorption variance says, hey, look, the more I produce, the more money I make, which from a financial accounting perspective is true for that particular accounting period. Let's say it's a month. Because what I'm doing is I'm taking my inventory and all the costs associated that I spent and putting it into the balance sheet, putting it into the inventory and sticking it up into finished goods or semi-finished goods or whatever. So it's now an asset and doesn't show up as a cost. Now, it won't come out of there as a cost until I sell it or I have to write it off because it's obsolete. Okay. And so that's what happens with absorption. It forces you to build inventory. It also forces a reluctance to change over your equipment. All right. Machine utilization, same thing. Purchase price variance. What's the best way a purchasing agent can get a lower price? If, let's say, the plastic cover on this, I'm buying from a plastic supplier, okay, from this mouse, and the standard cost on that is $1, right? And I say, well, geez, if I buy 50,000 of these, I can get it for 90 cents. So I'm going to show a 10-cent favorable purchase price variance. Well, what if I don't need 50,000? Yeah, but you got it on sale. Really? Okay, so now what happens when I have to write 20,000 of them off at the end of the year because I bought too many, or because the design changed? And when the design changes, this is obsolete. Okay, so oh yeah, the purchasing guy won. So what these purchase price variances do is promote the buying of unnecessary inventory. We got rid of that. And we came up with an index for a supplier that looked at not just cost, but all kinds of other things too, right? The indirect direct labor ratio, you probably heard me talk about this before, but indirect is anybody who's not making the product. Oh, that's all waste, right? No, it's not, because think about a NASCAR or Indy 500 or a Formula One race where you got a pit crew. Well, they're not driving, they're not direct labor, they're not driving the car. Let's just eliminate and improve our costs by eliminating the pit crew. What's going to happen? You're going to lose the race, right? And when you get back to standard work and think about the operator on a work sequence, that's his racetrack, if you will, and the people that supply materials to them and all that, water spiders, for example, are indirect. Okay. Now, I want to be efficient with my indirect labor, right? But to say they're wasteful is foolish. They're not. And the notion that operators should operate is no different than the race car driver should be on the track as much as possible. We don't want that race car driver extended times into the pit. We want him on the track because that's the only way he's going to add value and win the race. So the whole notion of this ratio and forcing operators who are direct to do indirect work is a total misuse and violation of standard work concepts. Operators should operate, okay? Direct labor variance. Also, all these variances that we had just promoted bad things for us, and we did not want to promote these bad behaviors through these things. So we basically said, gone. These are gone. We eliminated them. Now again, these variances are what you learn in school. So I'm looking at all this and boy, I just went through, all those cost accounting courses in school and my CMA and now I'm saying, no, these are not what we want to do with a lean mindset. All right. Capital appropriations, capital equipment. We would look at some arbitrary, net present value figure, right? And the funny thing is, when I first became CFO, I took all of the capital appropriation requests for the year before, and on those they had a box that said annualized savings. So all the engineers took all these overhead rates and labor rates and calculated all the great savings that all these capital purchases were going to provide, and put them down on this thing, and it got signed up by the CFO at the time and all that. Well, anyway, I added up all those savings for annual savings. It came out to be greater than our cost of sales. We were actually having people pay us to work there, if you believe those numbers. Okay, there's no way that we save that kind of money. So I changed the notion of this to say, look, these are the questions we're going to ask when we look at a capital request. Okay. And, why do you need it? What's wrong with the old equipment? Did you do Kaizen on the old equipment? What's the takt time? Is your new equipment going to be capable and all that? So I'll tell you a quick story. I was at a supplier that made a spring for us for our brake, and our volumes were going up, and the president's walking me around, and we got to this one area where they're assembling a brand new stamping machine, and the machine was $350,000. He said to me, "Is that machine over there?" I go, "Yep, we bought that for you guys because your volumes are going up and we don't have capacity on the old equipment." So we just got that new piece of equipment. Well, how much you pay for it? $350,000. I said, okay, great. I said, can you show me your old equipment that you're using? Because it was still running our parts. He took me over there. And again, not being an engineer, I was able to ask stupid questions like, hey, why is the die up here and the part down here? So what happens is, roughly 90+% of the cycle for one part is this die cutting air. It's cutting air always. It's not in any value until that die hits the metal, okay, and spits that apart. I said, can that be either brought closer in or speeded up without compromising quality? So I don't know. Let me get my engineers over here, right? Engineer came over, and by the way, they need about 30% more capacity out of this thing. And the engineer came over and said, yeah, it might cost a couple thousand in tooling, and we got to do this, we got to do that. But yeah, we can speed it up and get it up. How much you can get out of that cycle? Well, probably at least 50%. He bought a $350,000 piece of equipment because he didn't know how to do machine kaizen. Okay. And so here's dummy finance guy coming over there and asking these questions, And so if he had done machine kaizen, he would have saved that money. So these are the questions that we ended up asking on a capital appropriation request, right? And we were really, good at reducing our capital spend that would have been unnecessary, right? So, and you probably heard me talk about Nakao. I was on the shop floor once, and this engineer says, Nakao said we need a new machine. And, Nakao said, well, why do you need a new machine? Engineer said, because it's old. How old is it? It's 15 years old. Well, how old are you? I'm 32. Looks like we needed a new engineer too. Okay. Because he was so against having to buy equipment because it's old, especially if you didn't take care of it. Okay.
That's right.
And when I went to Hino Motors and spent one full day in the connecting rod line, which was a machining line, okay, the youngest piece of equipment was 10 years old. Okay. So target costing, this was a big one. Okay. And if you go back to that formula down below, your profits are a result of your cost because your selling price is going to be a function of market. Okay. So we designed in, and this is where my accountants became plant controllers, and we taught them to do target costing in our design team. They're integral part of the design team all the way through. And every toll gate, we looked at the cost of a product. So we knew, for example, that, in order to hit our profitability, our gross margin, that we needed to, hit a target cost based on the market pricing of that product. Now, a lot of companies say, well, look, our costs are X, so we need to make this much profit. So here's my selling price. Well, that doesn't work because there's markets for these things, and the market is indifferent as to what your costs are. Okay. So the bottom line of the Toyota formula is that your selling price, which is market based, minus whatever your cost is, will be your profit. All right. And so once we knew in our development process what the selling price was going to be, it was easy for us to calculate the costs.
Is the other way around, right? Yeah.
The target cost, right? So as we're going through the toll gate process in the design phase, we get to a say second toll gate or whatever it will be. We get to a toll gate, and the calculated cost is $700, but the actual target cost is $500. Well, guess what? That team has a $200 design task, cost task, to take that out of the design before it hits job one. Now, 70+% of your costs are locked into the design that you can't change.
Yes.
Okay, unless you change the design. And so that means when you go out and do Kaizen, you're only messing around with like 30% opportunity to affect that. So we thought, build in the profitability in the design phase through target costing, and that was unbelievably successful for us. And we became one of the most profitable divisions, I believe, because of this. Okay, we actually built in the profitability without compromising quality into the design itself. And when we produced that first product, we didn't have to go through that traditional product life cycle in terms of profitability. We made money on the first product out the door. Okay. Unnecessary reporting. Okay. We're producing all kinds of reports, and we knew that they were being read. And so what I did one month was I took the September report and just put the October date on it and reissued the same report in October. And out of 21 people, only one person came back and caught it. Okay. And that person, just told me kindly because he thought I was going to be in trouble. And he said, and I said, well, do you use this report? No, I just noticed that the date was wrong in the same number as the last month. I only use this one number on the 30th page. I just need that to put into my report for the president. I have no idea what that number is, but I take it and I put it in the report because he wants to know what it is. That's what went down. Okay. So we got rid of all this crazy reporting. And then we asked our customer, because this is important to do, know who your customer is. Okay. What do you need from us to run your business? Right. And that changed the total complexion. Now, one of the things I want to say about the reporting, okay, you do not need to be GAAP compliant or regulation compliant. You can do your internal management accounting on the back of a napkin if you want. It doesn't matter. So the bottom line here is you do not need to aspire to standards. You can do whatever you want. All right. Yeah, your financial reporting to the external side of the business, to the external market. Yeah, that's got to be in concert with generally accepted accounting principles. Okay, got all that. Not internally. Okay, so one of the things that happened, we went for a unit cost based on value stream. I'll give you one example. One of the things that we charged in was depreciation. So, based on the equipment you had in your value stream, you got charged whatever commensurate depreciation was for that equipment. So I had one guy come up to me and say, Mark, my per unit depreciation is $75 per unit. What the heck is depreciation? So I explained it to him. And he said, well, you mean to tell me that if I reduce the number of machines in my cell, that my cost will go down? I said, well, yeah. He says, well, I only need 6 machines and I've got 8. But if I take them out, well, which ones do you want to take out? So I looked them up on the fixed asset register. I told him how much money he'd save. His $75 might have went down to, 50. Well, I'm going to do that. Okay. Put him in the graveyard. He puts the 2 pieces of a brand new CNC equipment over into what we call the graveyard, right? Which is like kind of where we stored stuff that nobody was using because we didn't want it in the cell because it also affected the square footage charge. And we didn't want it there anyway because it created more walk time for the operator that was not necessary and all kinds of other things, right? So he gets rid of the 2 pieces of equipment. They were about $250,000 a piece, so $500,000, okay? The next month, I got a capital appropriation request for 2 Matsura CNC machining centers for $250 a piece. And I actually ripped it up right in front of them. I remember the guy's name was Marshall. He looked at me and said, what are you doing, Mark? Your machines are over there in the corner, in the graveyard. Okay. Now, I said, you still have to justify the equipment. No, you're not going to just go take them. Okay. But, and we said that just based on that accounting notion, okay, of accountability, Dr. M, we saved $500,000. Okay. Now, had it been the old traditional allocation, you never would have visibility at all on what was being charged into your overhead because it would have been one big lump overhead charge that had no data behind it and no detail behind it. And it wouldn't have been applicable anyway because it was just based on an arbitrary allocation. So that's an example of what the power of doing this, right? So getting rid of all this unnecessary reporting was key. A lot of times we were just looking for key pieces of data that we provided, online where you just got to look at, type it in and look it up. Didn't need to produce a report, all kinds of stuff. I moved my accountants to the shop floor. I was physically on the shop floor as the CFO. Okay. Assigned my cost accountants to plant controllers and assign them to cross-functional business teams. Now notice that these guys, these cost accountants and general accountants that I created as plant controllers, no longer needed to go around and fight fires in the accounting process, because we got a closing down to 2 days. And, so that first part of lean accounting is so critical to allow you to do accounting for lean. Okay. And that's a real key thing here, right? So if you're always swatting flies, you're never going to be able to get to the finish line, right? So that's what happened here. All those great changes we made earlier allowed them the time to be historians, the navigators now, rather than historians. So, we did the capital expenditures, target costing, value stream costing, cost improvement initiatives, we did all kinds of stuff. And we were actually called by the business teams, because when I got a call and said, hey, where's Gary? We need Gary on our team. These are design guys and manufacturing guys calling for an accountant on his team. We were value adding to the business, okay, and it was well noted. All right. This is the performance for Jake Break, Dr. M. You probably have seen this before, but this is a 10-year performance, okay. And you can see, I won't read the numbers to you, but you could see essentially that we did, triple, if not quadruple, the business with the same headcount. I don't know, 550, 575, right? And sales per employee, we were union, UAW, high cost Connecticut, and one of the most profitable companies in Danaher. Our EBIT was north of 30%, right? For a traditional, metal bending, not metal bending, but metal type of manufacturing company, okay? Because a Jake Break is a big hunk of metal that you drill holes and put components in, and obviously a lot more complicated than that, but that's what it was. And so this is a very traditional metal banging type of company. And we, with a UAW workforce in high cost New England, we were able to take this thing to over 30% operating income or EBIT. Okay. And so here you go. Look at our productivity, went from 3 to 35. Lead time, the whole 9 yards, basically was a unbelievable win. So this is a real quick one here, but this is, and I won't spend a lot of time on this, but this is the steps you need to go through to convert over to this type of an approach. Okay, anywhere from recalibrating your chart of accounts to reflect your value streams, converting your labor to overhead. Why do we just track labor? A lot of companies, like 8% of the cost is labor, and they've got more people focusing on accounting for labor than they do anything else. It's like, why are you doing that? Why are you spending an inordinate amount of clerical and accounting time tracking labor when it's relatively insignificant to the overall picture? Again, establishing general ledger codes, fixed assets, okay, reassigning your fixed assets to your value streams, your shared salaries, some salaries are shared, your purchase order conversion, making sure you're coding the purchase order to the right value stream. So in other words, if you had a general manufacturing account where you actually tracked your overhead cost, well, now I'm saying to you, well, look, if you're going to buy tooling or supplies for a value stream, you got to code it to that particular value stream, so those charges get right into your account, right? So that's a direct charge now to that value stream. Okay. ABC costing I talked about earlier, when necessary, and direct material costing, which again was all based on the actual price of materials going in and charged in from the bill of materials. So these are the steps. Now, I'll say this: you can't lead this as accountants. You have to follow the transformation that happens in the company. So I had a call one time from a company out of Florida, and the CFO said, "Hey, Mark, we want to do lean accounting because you're the father of lean accounting, and we want you to personally come in and show us what to do." And I said, "Well, tell me about your business." and they weren't doing any transformation at all. They were still batch and queue. They weren't, converting to value streams, and they weren't, they weren't thinking about how to backflush inventory. Things were still in functional departments. The whole notion of them doing anything differently, they wanted to do lean accounting, and I told them no, you can't do it unless your business changed. Okay, and they start transforming in that regard. So they got really upset with me. And like, what do you mean, Mark? We want you to come in and work with us. I don't know how to do it if you're not transforming your company. So I have to, decline your offer, because it's not possible to do this when you haven't done any changes on the structure of your company. So the message here is that you got to follow the changes that get made as you move through. Okay. And developing a value stream profit and loss statement, a value stream balance sheet, cash flow statement, product costing, and your KPI reporting on SQDC, safety, quality, delivery, and cost.
Mark, I think each of these we should go in detail in another episode also, because we can go through, but in another episode, these 4 slides that you're going to show, we should go in depth to this.
If you, we can do another session to go through every one of these steps, because
this
is
really,
where the important part is.
Value added.
Yep. Here's all about inventory considerations, Dr. M, in terms of elimination of your work orders and your WIP values and how you think about that, and backflushing I talked about earlier, inventory reporting. So all this stuff has to happen as well. So these were all the steps, okay, that you have to think about as you convert over. All right. And you're right. Maybe we'll do another session where I just take those slides.
So these 4 we can take separately, and for each of them we could spend. That would this session would be a precursor to a further detailed session. That's okay with you?
Yeah, that's fine.
Thanks a lot, Mark. Thanks a lot.
So that's it. That's it there. And I'm almost embarrassed to say, Dr. M, that lean accounting and accounting for lean is easier than what I learned in school in traditional cost accounting. Everybody says, "Wow, it's really complicated, Mark." No, it's not. It's not, if you think about it from the respect that it's pretty simple. And then the data and the cost data and all that is so easy for people to understand and make decisions like, hey, by the way, I got too many machines in my cell. Hey, what if I reduce my floor space by 30%? What's going to happen to my cost? All this stuff drives the right behaviors. No, I don't want to create more inventory because I know I'm going to get penalized for that. I want to adhere to just-in-time principles, all that kind of stuff, right? So it promotes the right things in the business. And that's the problem that we have with a lot of these traditional accounting and non-accounting measures, that they just simply, drive the wrong behaviors. Okay. And by the way, how you pay people, I didn't talk about this, but piece rate, you got to get rid of piece rate because you'll compromise quality, build inventory that's not necessary. You also, I was in one company client down in Arkansas, and I'm with the CEO and the CFO, Chief Financial Officer, and I said, how do people get paid out here? Everybody gets paid on machine uptime. And I said, well, geez, why that? Well, because we paid a lot of money for this equipment and we got to get our money's worth. I said, well, okay. Do you realize though that they're not changing over to another model because of that measure? And it's going, and they're not getting better at changeovers. So they're continuing to make model A when your customers are ordering model B. Okay, you got excess A's now you're gonna have to write off and all this stuff. And they're not doing preventive maintenance on the equipment, because if they shut the equipment down to do preventive maintenance, then that hurts their number. Well, yeah, well, I said, well, this is what you're doing, right? And by the way, you're losing business because you can't deliver, all right, because of these things. And so the CFO wasn't getting it. And I finally said to him, and I just learned the other day that he bought a brand new car. He bought a Lexus. So let me ask you a question. You just bought a Lexus, right? He goes, yeah. Good car. I said, hey, by the way, it's expensive, right? He goes, yeah. I said, well, when you get home tonight, are you gonna drive that car around the block 1,000 times just to get utilization out of your car? Well, why would I do that? I don't know. I said, look, you just got through telling me that all this equipment costs you a lot of money and you got to get your money's worth, whatever the hell that means. I said, so what about your car? Why is that any different? Well, I'd burn gas, I'd burn tires, I'd, wear and tear. Well, wait a minute now, you're not being consistent. If you are getting value out of running the heck out of this equipment, whether you need it or not, then why don't you do it with your car? And he finally got it. He said, I never thought about that way. Okay. So always trying to bring it back to Lee. I talk about this in my book, Flatlined.
Yeah.
Always drive this back to real life so people understand, because we do not run businesses and think about businesses the way we think about our own personal lives. So anyway, that's kind of the conclusion there, Dr. M, and hopefully that was helpful.
Yeah, and then all the questions, it'll be there. It is uploaded into my YouTube channel, and all the questions will be answered. So please do go through the YouTube channel and put it in the comments, and we'll revert to them. Right, Mark?
Right.
Thanks a lot, Mark.
Okay, Dr. M, see you next time.
See you.